Okay, so now we want to look at the spending multiplier with both a tax rate, so everyone in our example would be paying taxes, and also a savings rate. So like before, we'll make our tax rate 20%, and this MPS stands for marginal propensity to save. That is the amount that a person is going to save of the next dollar that they earn. And that's going to be different depending on how much money they already have earned. So say the first $1,000 that a person earns in a month, they're probably going to spend all of it. But then after they've earned $3,000 or $4,000 or $5,000 in that month, they might save quite a bit of the next $1,000 that they earn. Okay, but actually that's not going to matter too much for us here. We can just treat the marginal propensity to save as a savings rate that's not going to change, and we'll put it at 10%. So for every dollar that someone in our example earns, they're going to save 10 cents. Okay, so like before, the government's going to spend $2,000, and someone or some group of people are going to earn that $2,000 doing whatever the project is. Building a bridge, let's say. Okay, so these people are again going to pay $400 in taxes. After paying taxes, they will have $1,600, and they're going to save 10% of that $1,600. So $160. So the taxes and savings together are going to be $560. So of this, let's see, group one, they earn $2,000, but $560 is going to be put away, either paid in taxes or put in a bank somewhere. So they're going to spend everything else, but in this case, everything else is going to be 2,000 minus 560, so 1,440. Okay, so this 1,440 is going to be income for everybody in group 2. They're going to pay 20% in taxes. $288. After paying taxes, they'll have $1,152. They save 10% of that, so they save $115.20. Okay, so they're putting away, either in taxes or savings, $403.20. Okay, so they're going to spend the rest. So this is what they earned. This is what gets removed. So that's going to be okay. All right, we'll stop there, but let's look at, just for these rounds that we looked at, these cycles that we looked at, how much is added to aggregate demand. So the government spent $2,000, then group 1 spent $1,440. So that's or aggregate demand increases by 3,440. The curve shifts to the right. Now that figure is a little bit lower than what we saw up here at this same stage because of the savings. And then here, after group 2 spent $1,036.80, aggregate demand is going to be $4,476.80. $4,476.80. All right, now what is the formula for calculating the spending multiplier when money is being removed through taxes and savings? So this is in the reading, of course, but let me give you actually a slightly different version of the same formula. Okay, so 1 minus our tax rate times what we call the marginal propensity to consume, 1 over all of that. Now, we said that the marginal propensity to save was 10%, so therefore the marginal propensity to consume, that is just how much of the next dollar that you earn, or in this case, all the dollars that are earned in this example, are you going to spend. So if you're saving 10%, then your marginal propensity to consume is going to be 90%. Okay, so what do we have here? So 1 minus the tax rate times 0.80 times 0.90 over 1. That is going to be 0.72. So 1 over 0.28. Okay, so we're just getting a number like what we have here, but a little bit smaller. Okay, so figure out what that is. That will give us the multiplier in this case, and it is going to be, let's see, 3.571. Okay, so that's the multiplier given our tax rate and our marginal propensity to save and consume. And we use this multiplier the same way we used the last one. So the government initially spent $2,000. That $2,000 is multiplied by 3.571. And so aggregate demand is going to have increased by 7,142. All right, there we have it.